Welcome to another special episode of Honest Money. It's been a series where we've been joined by Grant Locke, who's head of OUTVest, and he's been putting me in the hot seat. So he's been firing the questions, and I've been sitting here squirming and answering as best as I can. And the theme of our conversations has been around global investing. So Grant, welcome. Thank you very much, and I'm looking forward to the next session.
Oh, thanks, Warren. It's good to be here, and I've really enjoyed putting you in the hot seat and watching you for a change. But I think, and this one is bound to be one of the most interesting one yet from my personal perspective, because it's the practical side of doing things. You know, we talk a lot about the theory and selecting the money and all the things that people think are exciting. But the thing you actually really need to know is, what do I do first? When I decided that I want to take some money out of the country, what is step one of doing this? Step two, step three, and step four. So these are the things I actually want to cover in this one. And then I think later on, what I really want to understand is, how can average be exceptional? It's one of the quotes from your book. And I wanted to understand a little bit more about why average is exceptional, because I mean, all of our life we're being told, listen, hey, you've got to be the best at this. And I think when it comes to investing, there's a slightly different way of thinking about it. But I think to start from the beginning, so to speak, let's go into, if I decide that I want to take money offshore tomorrow, what's the first thing I've got to do?
I think the first thing is just understand what the quantum is. So how much are you sending out?
Okay.
And that's very important, because there are basically two legal mechanisms we can use to send money out. So we can use what's called our discretionary allowance. So we can, which is R1 million a year. And
that's for every individual.
Every South African natural person over 18 to use the whole jargon. Okay. So someone over 18, not a company, not a trust, a South African person. They can send R1 million a year, and what they can do with it is they can use it as a travel allowance, so they can actually just spend the money if they're traveling. They can invest it, and they don't need to get permission from SARS. They don't need to get permission from the Reserve Bank or anybody. There are some processes that will get followed so that the Reserve Bank knows about it and it is reported. But as an individual, what you can do is you can send that money out through your bank. So you can say to your bank, I want to convert my rands into dollars or into pounds. Or you can use a specialist exchange trade company that says we'll get a better rate for you. But the first thing is that you need to say, okay, so if it's less than R1 million, I can use that discretionary allowance. Just be careful. If you use the whole R1 million and then you still want to go overseas and travel, you've run out of capacity. So that's a tricky thing. The other way to do it is, if you say, I'm going to invest more than R1 million, you can then apply to SARS for a clearance certificate, which says that you can send up to 10 million rand, again, per person, per year. So for most of us, exchange controls don't really exist, because very few people can send out 10 million rand every year and complain that they would like to have sent out more. So for those people, you do need to get a tax clearance certificate. Basically, what SARS wants to understand is they're not trying to stop you sending the money out. They want to know that it's gone out. They want to know where it's gone, so that they can continue to charge you tax on interest or capital gains tax, etc. And more importantly as well, from in the modern South African world, they want to know, where did you get the money from? So, if you were a drug smuggler or a previous government official sitting on a lot of dodgy money that you shouldn't have had, there are going to be some serious questions asked. So it's more about just understanding who you are, where the money's come from, that you do have the money. Then you can apply for the clearance certificate, and then you follow the same process that we mentioned of going either through your bank or a foreign exchange dealer, and you send the money out. So that's step one.
So step one is, okay, cool. Now my money is now going overseas. Okay, where's it going to land? What do I do next? How do I know where my money must go and where it must land? What do I do with it?
So I think the critical thing there will be to decide where the money is going to live. It's called the domicile or the jurisdiction of the investments. So a couple of reasons why this is, this sounds boring, but it's so critical to protecting your capital and letting it grow over time. If you invest your money in mainland America or mainland UK or even some parts of Europe, there is a real chance that if you pass away and you've got money invested in those countries, that you give their tax authorities up to 40% of your money for doing nothing.
Yeah.
Just because you chose to buy your Apple shares or your Berkshire Hathaway shares or your Vanguard 500 index in America, you pass away and you've got $100,000 sitting there, you're going to lose 40% of everything over $60,000. That will just be given to their version of the receiver of revenue, the IRS, and the Americans will love you for it, but your family won't. So where your money lives is critical to save tax, because there might be dividends tax on interest, withholdings taxes, something like that, in addition to the death duties. So choosing the home for your money is critical. Also because some of those jurisdictions, frankly, are just dodgy. They don't protect investor money. They might be, you've mentioned before that they might be blacklisted. So key issues. And then I think the last thing is deciding how long you're going to put the money there for. Because once you've said, okay, I want to send the money and I'm happy to invest it for a long period of time, which is my recommendation. Global investing, it's not a short-term thing. It should be a long-term thing. Then it's about saying, should I invest in shares? And then how do I buy my shares? Do I buy individual shares? Do I buy an index? Do I buy a unit trust?
But I think before we even get there, like, I actually want to go back a step. Just keep it really practical. Once it lands, do you have to open a bank account in the domicile you want to go to? Is that what you have to do? Or are there other ways of making sure that you can send your money there without you having to have bank accounts there? And if so, once it's in that bank account, or it's in, or however you've done it, do you need to find a provider, a services provider there? How do I go about doing this? And I guess keeping practical so that people can take those steps is really what I need to know from you.
I'm sorry, man. I'll do my best. So I think it's a common misconception that when you send your money out, it has to go from here, let's say from your bank account, and it has to arrive in another bank account overseas in your name.
Okay.
That's not true.
Okay.
That's one route. If you want to do it that way, that's entirely your choice. As we've just discussed, make sure the bank account is in the right jurisdiction then. But then you're sitting in a bank account denominated in pounds or euros or dollars, probably earning no interest, and some of those banks might even be charging you interest for you putting money there. So be careful. But there is a way, for example, that you can go from South Africa, convert your rands, goes into dollars, it goes directly into an exchange-traded fund, as an example, or into a unit trust, or into a kind of a stockbroking account or an investment platform. It doesn't need to go to a bank account ever. That's entirely your choice. I prefer not to do that, because I think it's another chain in this whole link of getting your money from one place to another, and you want as few links in that chain as possible, and you want as few costs as possible, because every step someone's taking some money from you. So you want to get it from your name in South Africa, overseas in your name, as fast as possible into the actual investment that you would like. Okay,
and I guess what would happen there is in the hypothetical scenario that for some reason you were not in South Africa, or you emigrated from South Africa and you wanted to withdraw that money again, you could just actually open a bank account in whatever that jurisdiction is that you're in, and then you can withdraw the money from your investment platform, your services provider, and it can land in that bank account. I think the key thing is, as long as the bank account that you're withdrawing into from your platform is in your name as well. I suppose that's the way to think about it.
Absolutely. I mean, I think that's again very practical solution to not having a bank account. So people always saying, well, what happens when I withdraw? Well, I mean, that's not a difficult thing to resolve when it comes time. And in the interim, if you're staying in South Africa and you haven't gone anywhere and you want the money back in rands, you can always bring the money back from your overseas account into your rand account. There's nothing stopping you doing that. I'm not saying it's a good idea, but if it's just very practical, you've been investing globally for 20 years and you need some of your money, you can do that. There's nothing stopping you bringing the money back. And then I think just lastly, there are some countries, Switzerland's a great example of this, where their bank account is also the place where you buy shares, where you buy unit trusts, exchange traded funds. So that is an administration platform, stockbroking platform, and a bank account all in one. And obviously, a jurisdiction like that is one worth considering from the point of view that they don't charge you taxes and all those kinds of things, well regulated, and it's giving an all-in-one account. The trick there, one of my industry colleagues would say, they charge like a wounded buffalo. So you've got to be careful with the Swiss that you choose something that if you're going to go there, that they're charging you the right fees. They're not too expensive.
I want to throw a curveball at you now. So we've discussed the traditional way of getting money out of the country, but you could also do it via Bitcoin. Would you? Would you send money out via Bitcoin and then use Bitcoin as your store of value and then exchange and then buy other assets in your personal capacity?
No. And maybe not, because I'm not into that whole debate of is Bitcoin an investment or I think just to park that for a second, it's really expensive to convert your fiat currency, so a government currency, into Bitcoin, and then to reconvert it from Bitcoin back into a government currency. So, for example, if you said, I want to convert my rands into Bitcoin, then I want to convert my Bitcoins into dollars somewhere along the line, it's going to end up costing you around about 30% of the value of your money.
Unbelievable. I had no idea. Is that all in the bid-offer spread?
It's partly in the bid-offer spread. It's also because it's not just converting it. You've got to get somebody, a kind of an institution, because it may not be a bank then, but somebody's got to take your Bitcoins and give you dollars. And that conversion is expensive.
Yeah, so actually the other point about it is that obviously because of the volatility of the crypto price, you really have a you don't have good sight of what you're going to get out at the other end. I mean, if you wait a couple of months or so, you could have a massive swing in the value of Bitcoin. So at the moment, if you were considering Bitcoin or cryptos as an alternative way to get out of the money, get money out of the country, you'd probably rather stick to the traditional method at this point in time.
And I think you're absolutely right. The volatility is a big issue, and also converting cryptos to rands or converting cryptos to dollars. There's also a price discrepancy there. So they call it arbitrage. And actually, it's I think at the moment, and as you say, these things change so fast, there's almost a detriment to converting your rands to crypto and then crypto into dollars. You're actually going to be worse off, even if the price of the crypto hasn't changed, because there's this arbitrage opportunity. So actually the other way around, converting dollars to crypto to rands might be better. But I think that whenever there's a gap in the market where something's mispriced, someone's taking advantage and narrowing that gap. So certainly not a recommendation for people.
And I think
that
the other point is that right now those transactions fall outside of exchange control, but at some point they will be regulated, and you need to make sure that you are complying with that regulation. If you're going via the Bitcoin route, it's in your personal capacity that you then have to make sure you report those transactions. And the fines and the penalties can be very, very severe. So at the moment, I'm with you in my personal capacity. I'd probably use the traditional methods, authorized broker-dealers, getting money out of the country. I think just going to the last point that I think is quite important before we move on to the why average is exceptional. When you're investing money, when you're actually putting it to work in the markets, you've got an element of understanding is, do I take all that money and do I just plug it straight into my investments, into my personal portfolio, or should I phase it in over time?
I'm quite a big fan of phasing my money into investments. So I'm always wary of taking. So let's just say I've converted my money. I've got $100,000 on the other side. I want to put it into a global index. The likelihood is that I'm going to take that $100,000. I'm going to cut it up into 6 equal portions, and I'm going to put it over 6 months. And the reason is that world markets just generally are incredibly volatile, like the JSEs as well. And so I want to average out the prospects of volatility, of prices falling or rising all the time. And the worst thing that could happen is I put my $100,000 in today, and tomorrow the whole stock market falls apart, and I could have bought it at a 30% discount. At the same time, I don't want to sit there with my $100,000 in cash, earning no interest, waiting for the stock market to fall by 30%, because it could take 7 years for that to happen. So I like to feed my money in. The only time I don't do that is if the stock market, just by sheer dumb luck, I've sent the money out, the stock market's collapsed before I've had a chance to actually invest. And if it's a huge drop, if it's one of those 30, 40, 50% drops, then I'd be really greedy, because then I'm going to get greedy when everyone else is fearful, and I'm going to invest my money into the markets very quickly. If the market's trending down a little bit, I'm going to stay with my 6-month view. And if the market's shooting up, definitely going to stay with my 6-month view.
That quote, it marks you out as someone who supports Warren Buffett, because his famous quote was, "Be fearful when others are greedy, and be greedy when others are fearful." Very, very sage investment advice. But it's very difficult to do in practice when you're actually looking at your investments running up and down. True. So I think the last point that I'd like to ask is, there's 2 things. How can average be exceptional in the world of investing?
So I'm going to shoot it back at you. How can it?
Okay, if you want to ask me about it, the way that you do it is just by doing little bits and pieces at a time, trying not to get the best return, trying to be ethical in the way that you invest, trying to invest sensibly, trying to just stay the course, and don't try and look at other people's investment performance as a measure of your own. Because the problem is, most people, I'm going to get a little bit technical here, is that maybe one thing that people don't know is that every single individual's investment return is different. You can invest in the same asset, but you will have a different investment return from the person sitting next to you. And that's a very fundamental element, is you cannot compare performance. So I think that's, in my world, just doing something in your own way, trying to make sure that you stick with your own plan, making sure that you do simple principles will over time compound up into something that you would not have believed. Yeah, you put me on the spot there. I hope I answered that. It
was a great answer. And so to add my own flavor to that, I think that if we're chasing returns, if we're chasing the ability to kind of choose the best share, the best property, whatever it is, the likelihood is we're going to end up with not the best. We're going to end up actually on the other side of that spectrum. So that's one thing. And then the second thing is that if you can just stick to an investment, so you put the money in and you've chosen, I know I talk about a lot, you buy an index and you just stay invested. That makes you exceptional. So although you're getting the average, because you're getting the average of the stock market index, that's the performance that you're getting, is the average of all of these different investments put together, put in an index. Very few people will buy an index and stay invested for 5, 10, 20, 30 years. So now, by just sticking the course, being in the average investment, what people call the average investment, you become exceptional because you're allowing your capital to grow on itself. You're allowing your money to make money babies, and those babies have babies, and before you know it, you've got thousands and thousands of money babies all over the place, and you are in a position of financial freedom. And I think that's the key, right? That's what we're all aiming for, is that financial freedom. But it's about saying, I'm not trying to get the best return next week, next month. I'm not trying to chop and change things. I'm just going to stay consistent and then add to it as I can, and try not to sell unless something's gone horribly wrong outside there where I need to make a change. But if it's just an index, you should be a seller kind of when you absolutely need the money one day to live off, and not for any other reason.
Thanks. Last thing. Okay, so in the last part of your book, you talk about some of the most important, boring lessons that you get from your clients. Can you take us through just one or two lessons that you've learned from dealing with your clients over the last 20 years?
So I think I might not be quoting my book directly because, frankly, it sounds terrible to quote yourself the whole time. So I think that one of the things I've realized about my clients is the ones that have achieved financial success over long periods of time, the people that have got to financial freedom, they exert control over their money. So they are the people that when they earn their first salary, they say, okay, I've got this money coming in. I need to make sure that I spend less than what's just arrived in my bank account, that I allocate some money to my long-term savings. Yes, I allocate some money for holidays or fun or whatever the deal is, but there will always be some money left over. I'm not going to spend everything. I'm not going to go into debt on day one. If I go into debt, I'm going to pay it off really fast. So it's people that sit there and say, this money animal can absolutely control us very quickly if we allow it. So what we're going to do is we're going to control our money. We're going to let our money work for us. We're going to make sure that our money aligns with what our objectives are, our important things in ourselves, either as individuals or as families. So it's about saying that money is a great tool when you use it correctly, and you have to control it. People who have money issues, chances are, they've got a credit card, it's easy to swipe or tap or whatever the deal is, and that happens day after day after day, week after week, and suddenly you owe the bank a huge amount of money. The interest is compounding against you at a massive rate. You're not controlling your money. In fact, you might not be working for a bank, but you're working for a bank, because actually what you're doing is you're paying interest to keep the bank happy, and so you're not exerting control. So they exert control over their money. They have a clear vision for what they want to do, for how they want to live their lives, and they've got a clear plan for their money, and they stick to it. And interestingly, generally not flash people. So the people that, I've had the privilege of dealing with financially successful people for more than 25 years. They could walk past you in the street and you wouldn't know. They're not flashy just in general. They might go on brilliant holidays. They might be the people that are sitting there in the Maldives, on the ski slopes, etc. But that's money that they've carefully saved, carefully budgeted for, and then they're spending that money on an experience. But by the time they get back to wherever home is, they might not live in the biggest houses. What you do know is there's no debt in their lives. They're not working for the banks. If they've bought a flash car, they've actually paid for it cash. It's something that they really can afford. And if they are using debt, it's a tool. It's something that they're doing with real strict control, and they're in control of that at all times. So I think that it's just understanding that being flashy just in general, living to impress others is a great way to lose money. it's a great way to make sure that you're actually working for the banks for the rest of your life, and you're working because you have to, not because you're in financial freedom. So I think flying below the radar to some extent, spending money on experiences is great, and then saving for the important things in life, and then just being humble and kind of being in control of your money, to me is an absolute key.
Warren, thank you very much. Really enjoyed it.
Thanks so much, Grant. Those are great questions.